Hello and welcome to a VSA video. I'm Ollie O'Donnell and today I'm joined by Victor Cantore, President and CEO of Amex Exploration, which is listed on the TSXV. Victor, thanks very much for joining me.
Well,
Really looking forward to hearing the story.
thanks for having me on. Really excited to talk about our company and where we're located and our great resource.
Absolutely. Well, look, this week you've released the highest grade assays ever at the Perron Project, 213 grams a ton over 3.75 meters, and with even higher intervals within that. So I think that gives, that really sets the scene for what is an incredibly high grade project in the Abitibi Greenstone Belt. So perhaps you can give us an overview of the project and the company as a starting point.
Absolutely. I mean, we're a company that we've really positioned ourselves as a near-term producer, but we're going on a dual path. We're going on a production side, and also we're continuing exploration. When it comes to location, this is really one of these stories where it's location, location, location. We're right in the center of the Abitibi Greenstone Belt, but it's not just being in the middle of the Abitibi Greenstone Belt. You're also right beside a former mining town. That mining town it's got about 800 residents, but it's all the infrastructure that it's got. So we're about 5 kilometers away from the town, so you're close enough to the town to take advantage of all its infrastructure, but at the same time you're far enough not to disturb them, and that's really where we have community acceptance, First Nations acceptance. There's roads, there's water, there's electricity, electricity to the project. So it's really exciting. Really looking forward to advancing this project. It'll bring a lot of high paying jobs to the community. And our land package is quite huge. Like right now, on the property, there's you're looking at 45.6 square kilometers of where all the mineralization is. But we've made some recent acquisitions in 2025 all along the Greenstone Belt. Now we're at almost 200 square kilometers of property, so a lot of unexplored property there, which we can go forward. And our geologists they're seeing a mirror image of what we have now, what we call the Beaupré block over on the new property. So yeah, it's quite exciting moving forward.
Can you give us an overview of the Perron deposit, and perhaps how it compares to some of the other producing mines in the Abitibi Greenstone Belt, and also why you decided to drill where there aren't any other projects, or developed mines.
Sure. Well, what there is really beside us is a former mining town. Just that it was a VMS mine, a volcanic massive sulfides. So nobody believed that there was actually going to be a gold mine right beside there. So it is a former mining town. What makes it really exciting is that it's probably one of the highest grade that you've seen around. Like, I mean, right now, what you see a lot of is you're looking a lot of these 1 gram material, but because of where gold is right now, that is high grade. But we've become like really ultra high grade. In the measured and indicated, for example, there's 1.6 million ounces at 6.14 grams per ton. When you put the indicated, measured, and inferred together, you're looking at 2.3 million ounces at around 5.4 grams. I mean, that's pretty high grade, from what you're seeing today. But really, the star of the resource is what we call the Champagne zone, which is where we had that spectacular drill hole that you were discussing earlier. Even on a small interval, there was 1,000 grams per ton, a little over 1,000 grams per ton on zero point 0.5 meters. But what the Champagne zone has is 831,000 ounces at 16.2 grams. I mean, that's a half an ounce. That's a little over half an ounce per ton. And there's another 128,000 ounces at 9.83 grams per ton. I mean, you're looking at about almost a million ounces at half an ounce, and that's right beside a town. It's that infrastructure is really important because you save hundreds of millions of dollars of infrastructure that you would have to put into place, which already comes there. The other thing that this project really has spectacular is the metallurgy. The metallurgy in the Champagne zone, which is where we're going to be starting most of the production at the beginning. It's the recovery has been 99% for both gold and silver. In the study itself, we use 95%, but it's really spectacular. Most of the recovery just comes in gravity, and then the balance of it comes through cyanidation.
So, well, moving on from the metallurgy, let's talk about the September PEA, because I think that'll bring a lot of the elements of the project together, because you've designed it really to capitalize on the infrastructure benefits that you talked about, and also the permitting timelines, which can be pretty long in Canada. But just give us an assumption, an overview of the PEA outcomes, and also some of the assumptions that you used in that, please.
Absolutely. So if we're using a base case, we use the base case of $2,500. I'm just going to jump straight. Like we did sensitivity analysis, all the way to 3,400, and I'm going to discuss those numbers. But we have sensitivity analysis even at $2,000 gold. I mean, we're looking at the double, or half of where gold is right now. And just to go briefly through those numbers, you have a post-tax payback period of 2 years, a post-tax IRR of 47%, and a post-tax NPV of $659 million. I mean, those are quite impressive numbers on its own. Now, if I move the numbers to 3,400, well, that post-tax IRR, instead of being at 47%, it jumps to 107.6%. And the post-tax NPV, you're looking at a 1.841. It's basically $1.8 billion NPV, and that's against capex, capital expenditures, initial capex of $146 million. I mean, normally that's a really your post-tax ratio of your NPV over your capex. A good number, a number that passes, is 2 times. 4 times is spectacular. When we use $3,400 gold, it's 13 times. Like, this project is really special, and where it becomes special is you've got it's high grade, great metallurgy, and you're right beside a town, and that's where you really get these payback periods, because you don't have to spend those hundreds of millions of dollars extra. When I look at free cash flow, I mean, this is really what we call, it's a cash printing machine. The post-tax free cash flow over the life of mine is $2.9 billion. If I go to pre-tax, you're looking at $5 billion. I mean, this is quite a spectacular project when you look at the numbers. I mean, the numbers speak for themselves. And look at your payback period. Your post-tax payback period at $3,400 gold is 0.4. That's basically, what is that, 5 months? So it's quite spectacular that you can put together a project and have it fully paid back post-tax in less than half a year. And there's so much exploration potential. This is not the only ounces we're going to have. We're going to continue exploring and adding to these ounces.
Yeah. Let's so with the production side initially. Yeah. There's various phases of production, including toll treating and then sort of owner operated. So how does that phase production align with the permitting schedule?
Absolutely. This is again where where the project is really special. Because of the high grade, we're going to be able to toll mill and start revenues. And because you're able to do that while you're bringing in revenues, you could start your phase 2, which would be owner operated. So the first thing that we're going to be doing is we've already applied for it. We applied for a bulk sample permit, but basically it's test mining. We're building the same infrastructure as with the same way we're going to mine it, even though it's, you call it a bulk sample, but basically you can call it pre-production. So we're expecting that permit to come any time between now and the first quarter of 2026. Construction would start then, and we would be finished around the middle of 2027. So middle of 2027, that's when you get your ore out of your bulk sample. You could send it for processing. While you're doing all that, we've already started a feasibility study for our phase one. We've started all our environmental impact studies to get all our authorizations. That's the timeline we put there is just slightly over 2 years. And once that's complete in 2028, see the way we've reverse engineered this. So once that's complete, because we're doing a production size bulk sample, that means all your infrastructure is the same size as a real production size. So in 2028, you don't have to wait to construct. Then it takes you another year and a half. You jump right into production at that point. And if things can go quicker, and hopefully we don't have to wait that from 2027 to 28, we can jump in a lot faster. But the numbers that we have on the production numbers that we have right now on our site on our Gantt chart, that's very conservative. It's very padded in there. And then we would be toll milling from 2028 all the way to 2032 while we're getting the balance of our permitting. And the reason you're able to go that fast is because when you're toll milling, you don't have open pits. We don't have our own tailings management facility. We don't have our own milling facility. So it's all being done at a third party, and that ends up making you de-risk from a technical level and also from a financial level, because then you're building out your phase two with the revenues that you're getting from phase one. That's why our initial capex is able to be so low at $146 million. There's not many projects today that you're going to be producing over 100,000 ounces a year, and your initial capex is $146 million. That again, that's another thing that makes this project special, because it's so high grade, because you're near a city, because you're near mills all around there. You're able to put this business plan together.
Clearly, there's a significant element of cash flow funding phase two. But what is the plan to fund phase one?
So phase one is $146 million. So the bulk sample should cost anywhere from $30 to $40 million, so somewhere within that range. Now it's all going to depend the authorization that we get. We've applied for 40,000 tons. If we do get 40,000 tons, we would be mining a little over 20,000. We would be mining a little over 20,000 ounces. At the current levels, in Canadian dollars, it's $5,000 Canadian per ounce. That's over $100 million. So our funding gap is not going to be that big, because the $146 million, the $30 million that we're putting into the bulk sample, that's already going to be a sunk cost. You have to remove it from the 146, and then minus the revenues that we're going to be getting. So the funding gap is not a big gap. I mean, we're looking. Most projects today, you're looking at $600-700 million and much more than that as your initial capex. Here you're looking at $146 million, minus what you're going to be getting from the gold sale. So it's really something you can put into production. And again, these are really small capex numbers, but you got to remember this: you're producing over 100,000 ounces a year. Like the first 10 years, the average is 112,000 ounces a year. If you're selling gold here at $3,200 an ounce, and your AISC is your all-in sustaining cost is just under $1,200. Actually, the average is $1,061. When you're making $2,000 an ounce, you're producing over 100,000 ounces. That's $200 million US, because these are US numbers. This on your all-in sustaining cost. That's $280 million Canadian that will be coming in on a yearly basis. That's where I say this is a cash flow machine.
Yeah. And in terms of, the other question in terms of permitting, what are your First Nations commitments at the moment?
Oh, it's great. There's the Casa Berardi mine, just it's about 80 kilometers north of us. That's in the Picogan territory, and they are very commercial. We get along with them. We've been dealing with them since we've started this project. We've never had any issues getting our drilling permits. They're definitely behind the project, and a big portion of this project is really underground. So there's not much above ground disturbance. Aside from that, we're 5-6 kilometers away from the town. We're not really disturbing the communities or any of the First Nations territories. So yeah, we get along with them. They're supporting us. They're going to be helping us along in getting our permits and moving this thing forward. It's really nice to be to be moving forward a project and you have community and First Nations backing. That's usually not the norm lately. So.
And then just on toll treating, lots of companies have the ambition to do it, but not that many actually succeed in getting started that way. How does $4,000 an ounce gold change the landscape for toll treating in your part of the world?
Well, there is spare capacity. We do have options. So just north of us, there's a Casa Berardi. It belongs to Hecla. There's a Holt Holloway, a couple hours away. And again, because it's high grade, transport doesn't really affect it much. When you're delivering half an ounce material, or if you're 15, 16 gram material during the bulk sample, it doesn't really matter on distance. A gram today, you're looking at $180 Canadian approximately for 1 gram. To deliver and toll milling, I doubt you would lose more than 1 gram. And I say losing more than 1 gram because I would say that it will not cost you $180 a ton to treat. So even if it does, you're losing one gram. And at $4,000 gold, the numbers get really they get really impressive at that number. We do have a sensitivity analysis at 4,000 also. I mean, you're looking at your payback period is basically post tax is basically 0.2. That's 2.5-3 months. IRR jumps to 130.6%. Like the numbers are really impressive. Like, to show you how impressive they are, right? When you go down to 2,000, they're still very good. It would pass, a project passes when you've got that kind of IRR and that kind of a payback period. So, yeah.
And the drilling that you're doing at the moment, that's infill to complement the feasibility study that you've started. Look, what is that? How significant and long will that drilling program be going on for? And then what are the deposit's still open at depth. So what other exploration can you do on the Champagne zone and the broader license area?
Absolutely. No, so we're not going to be doing any infill drilling for the phase one. The Champagne zone has been pretty much drilled up nicely. I mean, you're looking at 831,000 ounces in indicated, in measured and indicated, which normally those do convert easily into proven and probable. The result that we had this week was really it was for rock mechanics. Is to test the hardness of the rock, and it was nice, going through an area where you weren't expecting that kind of. We were expecting gold, but not that rich gold. So it just shows you that the Champagne zone just keeps going. On the exploration side, it's not just the exploration on the Quebec side. All our zones are open. Which zone? One zone is open at depth. One is to the east and south. It's really they're all open in one way or another. But there's so much exploration potential when you look at right now we control about 35 kilometers on strike and almost 200 square kilometers. So when you look at the footprint of the Champagne zone, and the Champagne zone it's about 200 meters on strike, and about 4 to 6 meters in width. I mean, there's a lot of champagne zones you can hide. You can hide in 200 square kilometers when you're looking at those numbers. So it's quite exciting. Like exploration is wide open. I mean, you got to let your imagination run wild on how much what is the real potential, what is the blue sky potential here to increase the ounces. And just with the ounces that you have right now, it's an extremely profitable operation. We put this as a 17.5 year mine life. In the last 10 years, you see the production dropping, but that's where we do believe we'll be able to backfill all the production there, and actually increase the ounces from making more and more discoveries along the belt. You're in the center of the Abitibi Greenstone Belt. There's gold everywhere there. It's one of the most prolific belts in the gold producing belts in the world. And when you control that much land, it's really amazing.
Sounds great. Let's just talk about the catalysts that are coming up in the next few months.
Yeah. So one of the most exciting parts right now is we're going to be looking on the approvals on the permitting, looking for an LOI with one of the local mills in the area. Also, what's really exciting is the drilling part now, where we're going to be doing more and more drilling, making new discoveries, expanding the known zones, signing the agreements with the communities, signing the agreements with the First Nations. Those are all catalysts that are coming. So we're going to have a lot of news over, like you're looking over the next 6 months. There's really a lot going on. And also when you look at these numbers and you compare these cash flow numbers, when you look at these financial metrics, I mean, we're really truly undervalued. These metrics really compare up against a lot of companies, even some with higher production, because you could have a higher production, but again, not all ounces are made the same. These kind of ounces are when you look at the cash flow that these kind of ounces generates and the profits that these generates, well, it's quite simple to look at. When you're looking at a deposit, if you look at the total numbers, the average is around 5.4 grams per ton. Most deposits today are in the 1 to 2 grams. So it's really a special deposit.
When I look at the board and the directors, there's a lot of crossover with the Northern Superior team, which has just been bid for. So is that kind of strategy something we can also look for with respect to Amex?
Well, look, I always say it's like anything else, right? Build it, and they will come. So you look at Northern Superior. I think that was a very, very successful operation. Simon Marcotte, myself, Peter Demouni, we were involved in this project right from the very beginning, when it was called Royal Fox Gold, and this was only in 2021 where we started this project. We merged with Northern Superior. We took over the management of it, and 3-4 years later, that was in 2022, and 3 years later, we made this very valuable for IAM Gold, and it was a great transaction for both companies. It's not just being bought out. It's not you're part of IAM Gold. IAM Gold's strategy. I mean, it's really a great company, well run, great company. There's a lot of growth there. So the shareholders that are getting IAM Gold shares, you just continue on. Now, can the strategy be the same for Amex? Look, we continue to build it. We're in the middle of the Abitibi Greenstone Belt. That's probably one of the things that keeps me up at night, is being taken over. It's kind of hard to look away at the kind of cash flow that this brings with such a small capex. So then that's why I say we're going in both directions. We're gonna work to build this thing. If somebody walks in and sees the real value here and buys it out, that's great. If not, we're gonna put this into production. It's a small capital expenditures, and the investors will reap they'll reap a lot of the benefits. So again, we do have a lot of optionality here, but usually it's what exploration companies do, right? We build it, and somebody else comes and takes it.
Fantastic. Victor, thank you so much for taking the time to talk to us. We very much look forward to hearing the progress.
Great. Thank you for having me on. And as we progress, we'll definitely see each other again. There's going to be a lot of news coming out over the next few months.